Two funds turn the same Google stock into an income product. One advertises the lower distribution yield, but has grown its net asset value. The other advertises the higher yield, but has lost NAV. Both finished positive after adding back the cash they distributed, but only one arrives at the examination table with both the capital base and the recent payout moving in the right direction. This is the strange case of GOOP versus GOOY, two synthetic covered call machines, one underlying company, and a reminder that the biggest number on the label can hide the weakest pulse underneath. GOOP is the Curve Yield Premium Strategy Google, or Google ETF, issued by Curve. It launched on October 31, 2023. This is an actively managed derivative income fund, not a plain index fund, and not a conventional pile of Google shares. Its listed holdings are United States Treasury bills at 109%, and the Fidelity Investments Money Market Government Portfolio, Class I, ticker FIGS, at 0.41%, plus 2 call options and 1 put option that the fund writes for premium income. That holdings list is the first clue to the machine. The Treasury bills and money market position are collateral, the sturdy table on which the options strategy is assembled. GOOP uses standardized exchange-traded options and customizable flex options to create synthetic exposure around Google stock, ticker Google. In plain English, the fund uses contracts to imitate much of the economic ride of the stock without simply owning the ordinary shares, and it sells option claims to collect premium. That premium helps finance the monthly distribution. The bargain is not free money. By selling calls, the fund gives another party a claim on some gains above the option terms. If Google launches upward, GOOP can participate only up to the boundaries created by those contracts. That is the capped gains part of the name. If Google falls, the premium is a cushion, not a parachute guaranteed to open. The put position, the exact option mix, and the manager's active choices can shape the exposure, but none of them repeal market risk. GOOY is the Yield Max Google Option Income Strategy ETF, issued by Yield Max. It launched on July 27, 2023, so it has the older starting date of the pair. It is also an actively managed derivative income fund with no conventional index. Its listed holdings are United States Treasury bills at 85%, United States Treasury notes at 25%, cash offset at 9%, and the First American Government Obligations Fund Class X, ticker FGXXX, at 3%, plus 3 call options that the fund writes for premium income. GOOY's chassis is therefore familiar: government paper, cash-related collateral, and an options overlay built around Alphabet's Google shares, ticker Google. It seeks synthetic exposure to the stock and sells calls against that economic exposure. Buyers of those calls pay premium. GOOY collects that premium and uses the strategy's available cash to support weekly distributions. The faster payment schedule changes when cash reaches the shareholder. It does not change where the cash must ultimately come from. GOOY makes the same central trade as GOOP. Current option income in exchange for surrendering some potential upside. A strong Google rally can run beyond the ceiling created by the written calls. A sharp Google decline can be larger than the premium collected. And because the exposure is synthetic, a viewer should not mistake a Treasury-heavy holdings page for a sleepy government bond fund. The government paper is backstage collateral. Google is still the star whose movement drives the drama. The strategic difference is in implementation and cadence, rather than a completely different species of product. GOOP uses exchange-traded and flex options, with both call and put contracts represented in the supplied holdings, and pays monthly. GOOY's supplied holdings show a call writing structure and a weekly payment schedule. Both manufacture income from option premium around the same company. Neither manufactures wealth merely by moving cash from the portfolio to the investor. The autopsy has to separate cash produced from capital consumed. This is research and education only. It is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold either fund. ETFs can lose value, including ETFs that make frequent or high distributions. Option positions, distribution rates, tax character, holdings, expenses, and fund policies can change. Verify the current prospectus, shareholder reports, distribution notices, holdings, and other official fund documents, and consult a qualified professional who understands your circumstances before making any decision. Now to the numbers designed to catch the eye. GOOP's headline distribution yield is 16%, paid monthly. GOOY's is 35%, paid weekly. GOOY clearly offers the larger advertised rate and the more frequent deposit schedule. Its headline rate is genuinely extreme. GOOP's rate is high, but not so extreme that it needs inflated superlatives. Since launch, GOOP has distributed $12.57 per share in cash. GOOY has distributed $16.55 per share. Those are meaningful cash totals, but the comparison needs context. GOOY, launched earlier, began from a different reference price and distributes on a different schedule. The larger cumulative pile does not prove that its shareholder became richer. It proves that more dollars per share crossed out of the fund and into the holder's account over the supplied record. Frequency has psychological power. Weekly cash can resemble a paycheck, while monthly cash resembles a bill-paying cycle. But a payment calendar is logistics, not economics. If a restaurant serves smaller portions every week instead of one plate each month, the serving schedule tells us nothing about whether the kitchen is profitable or quietly emptying the pantry. For GOOY, the weekly rhythm can make the strategy feel productive even when the capital base is under pressure. GOOP's monthly rhythm creates fewer moments of reinforcement, but each payment must pass the same test. What happened to the value left behind? The payout trend itself belongs in the risk examination, so we will not diagnose it here. For yield, the key distinction is that GOOY asks the investor to focus on the larger advertised rate, while GOOP presents the less aggressive one. The temptation is to treat that as a scoreboard. It is not. An option income distribution can be supported by premium, realized portfolio results, or cash that ultimately represents capital being returned. The tax label and economic source are not always the same question, so current distribution notices matter. Costs are close enough that they do not explain the dramatic difference in outcomes. GOOP's expense ratio is 0.99%. GOOY's is 1%. GOOY also has the larger asset base, $229 million in assets under management versus $27 million for GOOP. That may make GOOY look more established by size, but popularity is not payout quality. Assets under management tell us how much money chose the vehicle, not whether the vehicle protected each dollar well. So GOOY wins the visible yield contest: higher headline rate, weekly delivery, and more cumulative cash per share. GOOP offers the lower rate, monthly delivery, and less cumulative cash. But the real income question is not, how loud is the payout? It is, how much economic value survived after the payout was made. That takes us from the mailbox to the balance sheet. Net asset value is the per share value of the portfolio after the strategy, expenses, gains, losses, and distributions have done their work. This is where GOOP and GOOY stop looking like twins. GOOP began from a launch reference price of $25.33. Its latest NAV is $36.94, producing a 46% NAV return since inception. The container did not merely survive the cash leaving it, its per share value grew. That deserves real credit. A covered call structure is designed to surrender some upside, so a rising NAV shows that the remaining participation and portfolio results were strong enough to overcome the cash distributions and the strategy's constraints over the supplied period. GOOY began from a launch reference price of $20.51. Its latest NAV is $12.33, for a negative 40% NAV return since inception. That is substantial capital damage. The investor may have received frequent cash, but the claim still held in the account became much smaller. This is the classic danger of judging an income fund from one side of the statement. Deposits look busy while the asset producing them is losing weight. Head-to-head, GOOP held up dramatically better. Its NAV rose, GOOY's fell. This is not a comparison between two different sticker prices, where one simply looks larger than the other. They started from different levels. The meaningful evidence is direction and percentage change from each fund's own reference point. One expanded its internal value, the other contracted. The options bargain helps explain why NAV deserves its own examination. Both funds cap some gains in exchange for present income. But capped upside does not require NAV to fall. GOOP's record proves that a synthetic covered call machine can distribute cash while the underlying capital base still advances. GOOY's path shows the opposite possibility. Premium and frequent payments can coexist with major deterioration in what remains. A falling NAV can also make a distribution rate look more dramatic because the quoted rate is being compared with a lower share value. That can create a cruel optical illusion. The fund looks more generous precisely because the measuring base has weakened. The supplied data does not tell us the full day-by-day path or every cause of GOOY's decline, so we should not invent a diagnosis beyond the evidence. What we can say is that its capital record is poor, while GOOP's is strong. NAV is not the entire investor result because these funds deliberately distribute cash, but it is the health of the machine that must produce future results. GOOP reached the latest examination with a larger per-share engine than it had at launch. GOOY reached it with a smaller one. Before counting a single distribution back in, that is a decisive advantage for GOOP. Now we put the cash distributions beside the value still inside each fund. The supplied simple distribution inclusive return is the cleanest all-in comparison available here. It is not a personalized, tax-adjusted, reinvested performance calculation. It is a practical question. When cash paid and latest value are considered together, did the result clear the starting line? For GOOP, the answer is emphatically yes. Its simple distribution inclusive return since launch is positive 95%. That result is stronger than its already positive NAV path because the shareholder also received the cash stream. The important story is balance. GOOP did not need distributions to disguise a collapsing share base. Capital appreciation and cash delivery worked in the same overall direction. GOOY also finished positive on this measure at 41%. That point matters because on-life support is not the same as the investor received nothing or the entire record was negative. The distributed cash more than offset the supplied decline in NAV when combined through this simple method. GOOY created a positive economic result across its own since launch period, even though the remaining share value was badly wounded. GOOP is still the clear head-to-head winner on the all-in record. The lower headline yield produced the stronger simple total outcome. That is exactly why yield rankings can mislead. GOOY mailed out more cash per share and advertised the higher rate, yet GOOP left far more combined value in the evidence tray. There is an important fairness boundary. GOOP launched on October 31, 2023, while GOOY launched on July 27, 2023. Their since inception windows are close but not identical, and each experienced its own sequence of Google price moves and option conditions. This is not a synchronized laboratory test. The figures tell us what happened over each fund's supplied life, not what would happen if both strategies started on the same morning under identical contracts. The word simple also prevents overclaiming. A real investor's return would depend on purchase date, purchase price, reinvestment, spending, taxes, and transaction details. None of those personal inputs appears in the data. Still, the supplied measure answers the channel's core question without theatrics. GOOY's cash rescued its all-in result into positive territory. GOOP's cash added to a capital base that was already ahead. Rescue and reinforcement are not the same quality of outcome. Risk is not merely whether the final number finished green. It is the path endured to get there, and whether the income stream strengthened or weakened along the way. GOOP's maximum drawdown was negative 32%. GOOY's was negative 46%. Both are severe declines that could shake a real spending plan or tempt an investor to exit at the worst moment. GOOY suffered the deeper fall. GOOP held up better, but a negative 32% drawdown is not gentle. Anyone treating either payment stream as bond-like income would be ignoring the concentrated stock and options risk beneath it. Now inspect the distribution trends with the arithmetic facing the right direction. GOOP's first 4 distribution average was 27 cents per share. Its latest 4 average was 49 cents. The latest average equals 178% of the early average. The payout rose, and it rose substantially. That is a healthy signal in the supplied record, especially because it arrived alongside a higher NAV rather than a shrinking capital base. GOOY moved the other way. Its first 4 distribution average was 36 cents per share. Its latest 4 average was 8 cents. The latest average equals 23% of the early average. The payout fell sharply. A holder who mentally converted the early checks into a permanent weekly salary would have discovered that the salary was never guaranteed. The direct contrast is unusually clean. GOOP had the shallower maximum drawdown and a rising recent payout average. GOOY had the deeper maximum drawdown and a much lower recent payout average. One record shows improving cash output supported by a healthier capital path. The other shows a weakening check after substantial damage to the capital platform. Strategy risk remains even for the healthier fund. GOOP can lag a powerful Google rally because its written calls limit some upside. A sudden fall can outrun the premium collected. Option pricing can become less favorable, and active management can make decisions that do not work. Flex options offer customization, not immunity. Its smaller asset base is also something to monitor in current documents, without assuming any outcome that the data does not establish. GOOY faces similar call writing limits, plus the practical problem of trying to sustain attention-grabbing weekly cash after NAV has fallen. A reduced capital base has less material from which to generate future dollars per share. Its larger asset base shows that many more assets sit in the product, but scale does not reverse the per-share damage or guarantee a payout recovery. Tax character is another uncertainty, especially when a distribution may include return of capital. Return of capital is not automatically sinister. It can have legitimate tax and accounting treatment. Economically, however, an investor must still ask whether cash received was accompanied by enough portfolio gain to preserve the productive base. GOOP's supplied record answers that question favorably so far. GOOY's declining NAV and shrinking recent payment demand much more caution. The risk verdict is therefore not, options are dangerous, end of story. It is that implementation and results matter. The same underlying stock and broadly similar income idea produced very different scars. GOOP has demonstrated the stronger combination of drawdown control and payout direction. GOOY's record shows why a frequent distribution should never be mistaken for a stable one. GOOP's assigned verdict is clean bill of health. That label is earned by the supplied numbers. Its simple distribution-inclusive return since launch is positive 95%. Its price and NAV alone are positive 46%. Its latest 4 distributions average 178% of the first 4 average. The fund paid meaningful monthly cash, grew the per-share capital base, and increased its recent average payment. For this examination, the machine is not merely functioning. Its major vital signs agree. GOOY's assigned verdict is on life support. The label is blunt, but it does not erase the positive 41% simple distribution-inclusive return. Cash distributions did create enough value to leave the supplied all-in record above zero. The emergency is inside the remaining structure. Price and NAV alone are negative 40%, while the latest 4 distributions average only 23% of the first 4 average. The fund's headline yield is high, but the capital base and recent check both moved in the wrong direction. Positive total value keeps the patient alive. Deteriorating NAV and payout quality keep the alarms sounding. Head-to-head, the contrast is not income versus growth. Both funds try to turn Google volatility into current income through synthetic covered call strategies. The contrast is execution evidence. GOOP converted that trade into cash plus a growing asset base. GOOY converted it into more frequent cash but left a damaged asset base and a much smaller recent payment. The lower advertised yield produced the healthier overall record. That does not make GOOP a universal answer, and it does not make GOOY useless for every conceivable objective. They are different tools, and the fit depends on the goal. A researcher considering GOOP must accept capped upside, concentrated Google exposure, variable monthly distributions, active options management, and meaningful drawdown risk. A researcher considering GOOY must be willing to examine whether weekly cash is worth a record of deeper capital loss and a sharply reduced recent payout. The decisive question is not which fund sends cash more often. It is what job the investor expects the cash to perform. Someone seeking a durable capital base, someone spending every distribution, and someone trading short-term option exposure may evaluate the same evidence differently. None of those goals changes the autopsy. GOOP leaves with a clean bill of health, while GOOY remains on life support. Verify the current fund documents, because option books, distributions, holdings, and risks can change after this snapshot. Judge the cash together with the value left behind and make sure the failure mode fits the plan before admiring the headline rate. This comparison is research and education only, not a recommendation to buy, sell, or hold either fund. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick, and what matchup should we run next? We read everyone. Thanks for watching.